Well, greetings and salutations, test takers. This is the Series 7 Guru coming to you from my off-grid studio, getting my kicks on Route 66 with an explication request. And this is a Kaplan question. If you don't have a Kaplan Q Bank as a paid supplement, I highly recommend it. With my Guru 15 discount code at checkout, you can get that for as little as $55.80. Close to 4,000 practice questions. Most importantly, a performance tracker that will let you identify areas for remediation. For that commercial, Kaplan allows me to give you a free look on Kaplan content like this. We will help you explicate any question from any vendor. Just easier if it's Kaplan because you can just send me the QID and I can bring it up backstage. This is QID 156666785. An investor purchased a zero coupon corporate bond on the offering. Yeah, you're going to get tested on zero coupon bonds. You need to know that on a zero coupon bond, you need to do straight line amortization upward called accretion. Here, we're going to ask you to do practical application of that. I think it's mainly a recognition question. You know, when the person who created the first zero stripped the bonds of its income streams, hence the term zero coupon, we said, well, gee, I've held this thing for over a year. In this example, 12 years, that's a long-term capital gain. They go, no, 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 no. They say, Dean, there's an imputed interest you're receiving on this zero coupon bond. And we would like you to adjust your cost basis each year and pay taxes on that. So if I hold it to maturity, I would have neither a gain nor loss by this adjustment I'm about to show you. So definitely need to know straight line amortization upward, called accretion, and paying taxes on money you're not receiving kind of sucks. That's called fathom income. You need to know that these can be used to lock in a rate of return. Because with a bond with a payment every 6 months, you're getting paid. You got to decide what to do. But zeros are good for somebody who wants to lock in a rate of return. Zero coupon bonds have no call risk. So if you're interested in eliminating call risk, a zero might be the right recommendation. Zero coupon bonds are good for somebody who needs a set sum of money at some future date, like a college education. All that is very testable. All right, back to this question. The price was 520. The bond matures in 12 years. So as I just said, if our 520 is our cost basis is simply when we turn the investment into money. And it matures in 12 years, at which point I would get $1,000 if I held it to maturity. So if I hold this bond to maturity, I'm going to be making 480 over the life, right? I paid 520, I get back 1,000, that's 480. As we said, we have to do straight line amortization upward. So if I'm making 480 over 12 years, that means I'm making $40 a year in imputed interest. So I'm going to owe taxes on that $40, which kind of sucks, right? So $40 a year, I'm adjusting for year one, it'd be 560 would be my cost base, and I'm going to pay taxes on $40. At year two, it would be 600. Year three, 640. Year four, 680, right? You get the general idea here. Now it says 10 years after the purchase. So now what I got to figure out is what is my adjusted cost base after 10 years? So I can figure out whether 945 is good news or bad news, and gain or loss. All right, so the way I'm going to do that is I'm going to say, okay, well, I'm going to do straight line amortization upward. We've talked about that. We said you're going to be paying taxes on $40 you're not receiving, which kind of sucks. So I'm not going to be a good recommendation for somebody being in a high tax bracket. Maybe a kid's up my account or maybe a retirement account, something like that. But anyways, here we had it for 10 years. So if we've had it for 10 years and each year we've been adjusting the cost base up by $40, doing straight line amortization upward called accretion, our adjusted cost base would be 920. The 520 we originally paid plus the 400 in adjustment we've made to the cost basis each year. So that is my adjusted cost base of 920. It says I sell it for 945. Well, we've been at risk certainly for more than 12 months, and so that 945 is a $25 long-term capital gain. That is the answer to the question, right? My adjusted cost basis is 920. Sales proceeds are at 945. So the answer to the question is I have a $25 long-term capital gain. Now, on Series 7, you get three styles of questions. You get recognition questions, practical application questions, and judgment questions. I told you I would expect you to get this as a recognition style question. That being said, however, though, we want to make sure that we perform on practical application questions, math. There's no interpretation of a practical application answer. You just simply get it right or you get it wrong. You want to save your misses for judgment questions. Questions where you go, I'm not quite sure what to do here, right? All right, so I hope that was helpful. Remember, inch by inch, your Series 7 is a cinch. Yard by yard, your Series 7 is hard. If you have an explication request, send it to explicationrequest@guruexamprep.com, and we'll be more than happy to help you. I'll see you for the next explication request.